So Thomas Aquinas defines truth as what happens when the image inside my head of the thing I'm thinking about matches the reality of the actual thing, the thing that I'm thinking about. So if there's an equation between what's inside my head and the reality outside my head, then I'm in the truth. I am the thoughts I'm having are true thoughts. Mm-hmm. Now, of course, Aquinas realizes that you're going to have a third part of that equation, because you need an objective viewpoint, that someone that can arbitrate between those 2 points of reality in my head and the reality outside my head. Because I don't know if the reality inside my head actually matches unless I have some third objective viewpoint that tells me so. And of course, for Aquinas, that's God or Scripture or the teachings of the church. And so I started to think, what is that third objective viewpoint that God's eye view, as it were, in the market? Where does that come from? And if you throw out that question, I think, to professional money managers and traders and so on, you're going to get a whole bunch of different answers. There are folks that tune into CNBC listening to the talking heads, Jim Cramer and all the rest, and they're looking for that definitive objective view of the market. They're not going to find it there, of course. Mm-hmm. You can look at the Fed. The old adage, don't fight the Fed. Well, if the Fed is hiking rates, you should be out of the market. If the Fed is lowering rates, you should be in the market. Also not a very good way of going about your investing. In fact, the Fed hiked rates the fastest and the shortest distance of time in history not too long ago, 2020 and 2022, 2023. And the market went up during that time. If you looked at the first hike to the last hike, it went up about 7 or 8%. It wasn't a straight line; it was up and down. But
right.
Back in 2016 to 2018, the Fed hiked a bunch of times as well. The market was up 20% during the same period. So, no, it's not the Fed. It's not the VIX. It's not, which doesn't really work anymore anyway, because of these crazy expiration dates are all over the place now, like every day for the spider. Mm-hmm. So the VIX doesn't work. The leading indicators is no longer a good voice for recession. The inverted yield curve, no longer a good voice for recession. So what is that objective viewpoint? Well, the answer I find in the writings of William O'Neill. His objective viewpoint always was and always will be, for those who follow him, the price chart. The price chart is your objective viewpoint. So I can have a bullish bias toward the market. I can have a bearish bias toward the market. I can think the market's going to crash because of high credit card rates. I mean, they're really crazy. The credit card rates, not both in terms of interest and money owed and defaults, are also all not looking very good. And I can look at that and think, okay, the market's about to fall. I look at the market. I look at the price chart of the market. It doesn't say anything about to fall. There's nothing in there that's telling me it's about to fall. And if you had just listened to the market and traded the market as it is presented to us on a day-to-day basis, you would be doing just fine, because the market's been very bullish since the October low and really bullish since the end of 2022. So, so that objective viewpoint in terms of the market is the price chart. That includes both price and volume. I think William O'Neill was right in including volume as an important key to understanding market trend and the likelihood that it's going to continue. And it's not an infallible predictor at all. And neither is price, for that matter, because a catalyst can come down the road, something unexpected out of the blue, and of course then everything is off the table. Yeah. You've got to flex with that. But if you're just looking at the price chart, you look at QQQ, you look at SPY right now, and you're going to see bullish, bullish, bullish. And that's, as far as I'm concerned, that's the narrative going forward until otherwise known, until some other information comes out that the market will have to discount. The market, of course, I say this many times, is a future discounting mechanism. So it's always out there 2 to 3 months. It's already trading that first rate cut, which we'll probably get in May. A lot of folks still think we're going to get it in March, but I think more likely May. but we're there. That's where the market is. It's looking out there. It's looking past these earnings, which were pretty good, not horrible. They were pretty good all around, and looking out to the next quarter. So, if that's the case, then let's just listen to the market. Let the market tell us what it's doing.